everyone. So the market's been a bit of a roller coaster lately, right? I mean, tariffs, tech stocks soaring, and whispers of a recession. It's a lot to keep up with.
Definitely. It feels like every day brings a new headline to worry about.
Exactly, and that's why you sent over this mountain of articles and reports, right, to try to make sense of it all.
That's exactly right. We've got opinions from seasoned economists, Wall Street veterans, even some deep dives into specific companies and sectors.
Perfect. That's what we love to see. So our mission today, to help you cut through all the noise, spot those opportunities others might miss, and ultimately feel more confident about your investment decisions.
Couldn't have said it better myself. Now let's start with a snapshot of the economic landscape. Several of the reports you sent highlight a strong consumer base, healthy job market. Some even argue that 2 to 3% growth is a sign of a solid economy.
But there's always another side to the story, isn't there?
Of course, some experts you sent over are a bit more cautious. They're pointing to that persistent inflation and the possibility of an economic slowdown.
Right, because inflation just won't quit, and then there's this whole debate about government spending.
Absolutely. One advisor really hammered this point home. He talked about how the U.S. deficit exploded after the pandemic and never fully recovered.
Oh, I remember reading that. He basically argues that this ongoing deficit spending is like pouring gasoline on the inflation fire.
Right, and that puts the Federal Reserve in a really tough spot. They're trying to cool things down with these rate hikes, but at the same time, the government's pumping more money into the system. It's like they're working against each other.
Totally. So is the Fed actually responding to real-time data, or are they more focused on political pressures? I mean, one analyst even used the term comfortably numb to describe their approach.
Comfortably numb, definitely not the most reassuring phrase, is it? But it does raise the question of how much the Fed is reacting versus predicting. And speaking of reactions, remember the market's little freak out when those new tariff threats surfaced?
Oh yeah, that was a wild couple of days. Makes you wonder if folks on Wall Street ever sleep.
Well, it's a classic example of panic in action. We have to remember the market is driven by emotions as much as logic. But here's the thing, sometimes those knee-jerk reactions can create openings for savvy investors.
Because when everyone's running for the exits, that's when you can find some hidden gems on sale. It's like Black Friday for stocks.
Exactly. And tariffs specifically have a way of creating what one expert called dislocations in the market.
Hold on, dislocations? That sounds kind of painful.
Well, it can be, but it can also lead to some interesting gains. For example, imagine a company with factories in, say, Mexico and Canada.
Okay, I'm picturing it.
Their stock might initially plummet because investors fear the impact of tariffs, right? But if that company has solid fundamentals and can adapt their supply chain, maybe shifting production or finding new suppliers, then their stock could rebound, potentially even outperform its previous highs.
So it's less about avoiding companies directly hit by tariffs and more about spotting the ones who can adapt and emerge stronger.
That's the key. It's about looking beyond the immediate headlines and seeing the bigger picture. And this actually segues nicely into another topic you sent over. The Magnificent Seven.
Ah, yes, the Mad Seven, those tech giants everyone's talking about. Artificial intelligence, data centers, mind-blowing growth. It's hard not to be at least a little bit fascinated by them.
True, their recent performance has been extraordinary. But even the most impressive companies can't defy gravity forever, and some of your sources are raising red flags. We're seeing a deceleration in their earnings growth, valuations that seem stretched,
And one expert even drew a parallel to the dot-com bubble of 2000.
Right, that definitely gives you pause. There are some striking similarities. We're seeing concentrated market power in the hands of a few price-to-sale ratios that are raising eyebrows.
Okay, so not a perfect comparison, but definitely something to watch.
Exactly, because it highlights this idea of a relative slowdown. They're still growing, just not at that crazy pace we've gotten used to.
Right, relative slow go, I'm getting it. But what does all this mean for investors who are looking beyond the Mag 7? I mean, where should we be focusing our attention?
That's the exciting part. It's about finding value in those companies that might not be making headlines but have a strong foundation and great potential. Like, remember LMR, the lithium producer we talked about earlier?
Oh yeah, lithium. That's essential for electric vehicle batteries, right?
It is. Now, while the U.S. electric vehicle market might be cooling a bit, global demand for lithium is projected to explode, driven in large part by China. LMR is well positioned to benefit from this trend, and because lithium prices are cyclical, they're poised for a strong comeback.
So even if LMR doesn't have the same buzz as, say, Tesla, it has solid fundamentals and a growing market. That's starting to make sense.
And there are others flying under the radar, too. One article highlighted Cooper Standard, a company that makes auto parts. I know, it doesn't sound too glamorous.
Auto parts? Not exactly setting my world on fire.
But it perfectly illustrates how those dislocations we talked about can create opportunity. Cooper Standard does a lot of their manufacturing in Canada and Mexico, so their stock took a hit when tariffs were threatened.
Right, because of the potential impact on their supply chain.
Exactly. But people still need cars. Cooper Standard is a leader in their niche, and their long-term prospects remain strong.
So instead of panicking about headlines, we should be looking deeper to see who's actually positioned to benefit from these market shifts. I like this approach.
That's the idea. It's about finding those hidden gems that others might overlook. And speaking of hidden gems, there's another category we should discuss: small cap stocks.
Small caps, those always seem a bit riskier to me.
They can be, no doubt, but they also offer the potential for outsized returns. One analyst highlighted the Russell 2000 index, which is projected to have significantly higher earnings growth this year than the S&P 500.
Really? Are you saying small caps, which are often seen as riskier, could outperform the big established companies?
That's what the data suggests. They're often overlooked, so small cap stocks can be undervalued relative to their growth potential.
So we've got boring but beautiful companies, small caps potentially staging a comeback. Where else should we be looking?
Well, let's not forget about a core component of any balanced portfolio: fixed income. Especially when the market is volatile, bonds can provide much-needed stability and income.
Okay, that makes sense. But honestly, when I think of exciting investments, bonds aren't exactly the first thing that come to mind.
I understand. But don't underestimate the power of actively managing your cash. Right now, bond yields are actually more attractive than what you'd get from many stock dividends.
Seriously. So you're saying I could potentially earn more from bonds than from stocks? That's surprising.
It might seem counterintuitive, but it's true in the current environment. Of course, with bonds, it's all about duration, how long you're willing to hold them. And with the possibility of future rate cuts, short-term bonds could be a safe haven to protect your capital.
Capital preservation, in other words, not losing money. That's always a good thing.
It is. But now for something truly fascinating, let's talk about one of the hottest topics you sent over: Coinbase and the world of cryptocurrency.
Coinbase, that one definitely piqued my interest. But honestly, the whole crypto thing still feels like a bit of a mystery to me. It's exciting, but a little intimidating at the same time.
Well, that's what makes it so compelling, and Coinbase is a perfect case study, sitting right at the intersection of traditional finance and this potentially revolutionary technology.
One article called it the world's best, most established crypto exchange. That's a pretty bold claim.
It is, but they've built a strong reputation for security and reliability, which is essential in a market that can feel a little, shall we say, unpredictable.
Yeah, unpredictable is one way to put it. But is Coinbase just a gamble on Bitcoin and other cryptos that could ultimately crash and burn?
That's certainly a valid concern, but this is where the concept of optionality comes into play. Coinbase isn't just an exchange. They're a tech company actively developing tools and services that could have uses far beyond buying and selling Bitcoin.
Okay, I'm intrigued. Optionality, what does that actually mean in this context? Give me an example.
Think about stablecoins like USDC. It's a type of cryptocurrency that's tied to the US dollar, so it's designed to be much less volatile than something like Bitcoin.
So it's kind of like a digital version of the dollar. But why would anyone use that instead of just regular dollars?
It's all about efficiency and accessibility. Stablecoins can be sent globally, almost instantly, and with very low fees. Imagine trying to send a traditional wire transfer internationally. It can take days and cost a fortune.
Oh, I know that pain all too well. So stablecoins could really revolutionize international payments and things like remittances.
Exactly. And Coinbase is a major player in the stablecoin market. They generate significant revenue from USDC transactions and are heavily invested in developing new products and services built around stablecoins.
So even if Bitcoin faces some challenges, Coinbase could still thrive thanks to these other ventures. That's a fascinating angle. But the whole blockchain thing still feels a bit abstract. What's the real-world potential here beyond just making transactions faster?
Think about the way we currently move money around. It's slow, expensive, and often lacks transparency. Blockchain technology has the power to revolutionize all of that. Imagine a financial system that's faster, cheaper, and more transparent.
That sounds pretty amazing, actually. But are we really talking about replacing the entire financial system as we know it?
That's the big question, isn't it? And it's one of the reasons why Coinbase is such a compelling company to watch. They're not just facilitating transactions, they're trying to build a foundation for a whole new financial ecosystem.
Wow, that's a bold vision. But realistically, what about the regulatory hurdles? Won't the government try to control all of this?
Absolutely. The regulatory landscape for crypto is constantly evolving, and it's one of the biggest risks facing Coinbase.
So they could build this incredible technology but then get shut down by regulators. That seems like a real possibility.
It is, but Coinbase is proactively engaging with regulators and advocating for clear, sensible guidelines. They're also investing heavily in compliance and security.
Okay, so it's not like they're just a bunch of techies working in a garage hoping to disrupt the system. They're actually trying to build a legitimate and sustainable business.
That's exactly what makes them so interesting to follow. It's a high-risk, high-reward situation. If they succeed, they could be leading a massive technological shift. But if they fail, It could be a very costly lesson.
It's a fascinating story unfolding in real time. Okay, I think we've covered a ton of ground in this first part of our deep dive, from the overall economic outlook to the Magnificent Seven, from the potential of small caps to the steady appeal of bonds, and now this deep dive into the world of crypto. I feel like my brain is overflowing.
We've definitely explored a lot. But that's the beauty of a deep dive, isn't it? We uncover a world of possibilities and equip you with the knowledge to make more informed decisions.
It really is, but I'm not going to lie, I need a moment to process all this information. What would you say is the key takeaway from all of this? What's the one thing our listeners should keep in mind as they navigate this complex market?
If I had to boil it down to one essential principle, it would be this. Don't be afraid to be a contrarian.
Contrarian, you mean going against the crowd, but isn't that risky?
It can be, but remember, the market is often driven by fear and greed. When everyone's panicking and selling, that's often the best time to buy. And when everyone's euphoric and buying, that's often the best time to sell.
So it's about staying level-headed, doing your research, and not getting caught up in the hype.
Precisely. And here's something else to remember. Volatility can actually be your friend.
Volatility, isn't that a bad thing?
Not necessarily. Volatility creates buying opportunities for those who are prepared.
So when the market dips, that's our chance to swoop in and snag some bargains.
That's the idea, but it's essential to be selective and focus on companies with strong fundamentals. Don't just buy anything that's on sale. Make sure it's a quality asset that's temporarily undervalued.
I see. So be contrarian, embrace volatility, and focus on fundamentals. I think I'm starting to get it.
And there's one more crucial ingredient for success in the market, and it's something that can be challenging, even for seasoned investors.
Let me guess, it's patience, right?
You got it. Real wealth is built over time, not overnight. It's a marathon, not a sprint. Don't get discouraged if your investments don't take off immediately.
So slow and steady wins the race, just like the tortoise and the hare.
Exactly. The market is full of hares jumping in and out of stocks, chasing the latest trends. But the tortoises, the ones who are patient and disciplined, they're the ones who ultimately reach their goals.
I love that analogy. From now on, I'm channeling my inner tortoise, slow, steady, and contrarian. But hey, speaking of slow and steady, what about investments that feel a little more grounded? Less about the ups and downs of the market?
You're reading my mind. You actually included some really interesting articles about real estate. Is that an area you've been thinking about?
Honestly, yes. It's something I've always been curious about. Real estate feels tangible, and can see it, touch it. It feels more stable than the stock market, which can be a bit of a wild ride.
I understand. There's definitely something appealing about investing in something concrete, something you can physically see and touch.
Exactly. But at the same time, it seems incredibly daunting. Where do you even begin with real estate investing? Do you have to become a landlord or start flipping houses?
Not necessarily. There are actually a variety of ways to invest in real estate without taking on those responsibilities. Remember those REITs we touched on earlier?
REITs, those were.
Real estate investment trusts. They're companies that own and manage income-producing real estate, like shopping malls, office buildings, apartments, you name it.
Ah, right. So instead of buying an entire apartment building, you could buy shares in a company that owns a bunch of them.
Exactly. REITs offer a way to participate in the real estate market without the hassles of being a landlord. Plus, they tend to pay out a good chunk of their profits as dividends, which could be a nice source of passive income.
Passive income music to my ears. But what about actually owning physical property? Isn't that the real key to building wealth in real estate?
It could be a great wealth-building strategy, no doubt. Owning rental properties can provide consistent cash flow and the potential for appreciation. But it also comes with responsibility, finding tenants, managing repairs, dealing with vacancies.
Yeah, those don't sound super fun.
I hear you. But what if you're just interested in buying a home for yourself? Would you consider that an investment?
Well, it's definitely a big purchase, but I've always thought of it more as a place to live than as an investment.
I get it, and it's important to think of your home as a place to create memories and build a life. But it's also a financial asset that can build equity over time.
So even if I'm not trying to be a real estate muggle, just buying a home for myself can be a smart financial decision.
It can be, especially if you plan to stay there for several years. Over time, you'll pay down your mortgage, build equity, and potentially benefit from appreciation if property values in your area go up.
Makes sense. So we've got REITs, rental properties, primary residences. Are there any other ways to get into the real estate game?
There's also commercial real estate, which includes things like office buildings, warehouses, industrial spaces, properties used by businesses.
That sounds even more complicated than residential real estate.
It can be, but commercial real estate can also offer higher potential returns. And you don't necessarily have to buy an entire skyscraper to get involved.
Really? How does that work?
Well, there are investment funds and platforms that pool money from multiple investors to buy commercial properties. This allows you to gain exposure to a diversified portfolio of commercial real estate without needing a ton of capital.
So it's kind of like a REIT, but for commercial properties.
Exactly. These funds offer a way to tap into the potential of commercial real estate without the burden of directly owning and managing the properties.
Okay, we've got REITs, rental properties, primary residences, commercial real estate. My head is spinning. How do we make sense of it all?
That's the fun of a deep dive, isn't it? We uncover a world of possibilities and empower you to make informed decisions. But that's a topic for our next segment, so stay tuned.
Okay, I'm definitely ready for more. But first, I think our listeners to use a break to digest all this great information.
Agreed. Let's take a pause and come back for part 2, where we'll continue exploring the fascinating world of real estate investing.
All right, so we've got REITs, rental properties, even our own homes as potential investments. But what about taking our real estate game global? You mentioned something called the passport trade earlier.
Right. The passport trade is all about exploring investment opportunities in real estate markets outside of the U.S.
So basically looking for deals in other countries, but isn't that super risky? I mean, currency fluctuations, political instability, it seems like a whole other level of complexity.
You're not wrong. There are definitely additional challenges to consider when venturing into international real estate. But there's also the potential for greater returns. Remember, many international markets are currently undervalued compared to the U.S., and some are projected to grow at a much faster pace in the coming years.
It's like finding those hidden gems, but on a global scale.
Exactly. But it's crucial to do your homework. Understand the specific risks involve things like currency fluctuations, political instability, and varying regulations. All of these can impact your investment, so it's not as simple as just picking a country at random and hoping for the best.
Okay, so definitely not a strategy for the faint of heart.
No, it requires a certain level of risk tolerance and a willingness to really dig in and do your research. But for those who are prepared to put in the effort, the potential rewards can be significant.
I can see the appeal. It's like adding an adventurous twist to your real estate portfolio, but honestly, my head is already spinning from all the information we've covered today. We've talked about so many different types of investments, and I'm starting to feel a bit overwhelmed.
That's understandable. We've covered a lot of ground, from the economic landscape to the Magnificent Seven, from the potential of small caps to the steady appeal of bonds, and now a deep dive into real estate. So what's resonating with you the most? What's sticking out in your mind?
Well, if I had to pick one time takeaway so far, it's this idea of being a contrarian investor. It's a bit intimidating, to be honest, but also kind of exciting. It feels like a different way of thinking about the market.
I understand. It definitely challenges the conventional wisdom, right? But remember, the market is often driven by those emotions, fear and greed. And when everyone else is panicking, that can often be the best time to buy. And when everyone's euphoric, well, that's often the best time to think about selling.
It's about staying calm and collected, not letting those emotions get the best of you. Do your research, don't get caught up in the hype, and think for yourself.
Exactly. And here's another important point. Volatility isn't always a bad thing.
Wait, really? Volatility, isn't that what causes all the stress?
Think of it this way. Volatility creates opportunities. For those who are prepared, it could be a chance to buy quality assets at a discount.
Okay, so when the market takes a dip, that's our cue to look for margins.
Exactly. But remember, be selective. Focus on companies with strong fundamentals, those boring but beautiful companies we discussed earlier. Don't just buy anything that's on sale. Make sure it's a solid investment that's temporarily undervalued.
Be contrarian, embrace volatility, focus on fundamentals. Got it. But let's be honest, it's easier said than done, right?
There's another crucial ingredient here, isn't there?
You're absolutely right, and it's one of the most challenging aspects of investing, even for experienced investors.
I bet I can guess. Patience. You nailed it. Building real wealth takes time. It's a marathon, not a sprint. Don't get discouraged if your investments don't skyrocket overnight. Remember, slow and steady wins the race.
The tortoise and the hare, right? I love that analogy.
Exactly. The market is full of hares jumping in and out of stocks, chasing the latest trends. But the tortoises, the ones who are patient and disciplined, they're the ones who ultimately achieve their long-term goals.
I'm officially adopting the tortoise strategy from now on. But let's shift gears for a moment and talk about a topic that came up in your research, Coinbase and the world of cryptocurrency. It's exciting, but still a bit of a mystery to me. Are we really betting on the future of digital currencies?
Well, that's the billion-dollar question, isn't it? Crypto is still a relatively new and evolving asset class full of potential and uncertainty, and Coinbase sits right at the heart of it all.
I remember one article calling it the world's best, most established crypto exchange. That's a pretty impressive title.
They've definitely built a strong reputation, especially when it comes to security and reliability. And that's really important in a market that, frankly, can feel a bit like the Wild West at times.
That's a good way to put it, but is Coinbase ultimately just a gamble on Bitcoin and other cryptos that could potentially crash and burn?
That's a valid concern, for sure. But this is where the idea of optionality comes into play. Coinbase isn't just an exchange, they're a tech company actively building tools and services that could have applications far beyond simply buying and selling Bitcoin. They're thinking about the bigger picture, the future of finance.
Optionality, that word keeps coming up. I'm still trying to wrap my head around it. Give me a concrete example of what you mean in the context of Coinbase.
Think about stablecoins, like USDC. It's a type of cryptocurrency pegged to the US dollar, so it's designed to be much less volatile than something like Bitcoin. Think of it like a digital version of a dollar, but with the added benefits of blockchain technology.
Okay, I'm following, but why would anyone choose to use a stable coin instead of just using regular dollars? What's the advantage?
It's all about efficiency and global reach. Stablecoins can be sent around the world almost instantly, with very low fees. Compare that to traditional methods like wire transfers, which can take days and cost a fortune.
Right. International wire transfers are the worst. So stablecoins could really change the game for global payments and things like remittances. That's a pretty good deal.
It is, and Coinbase is a major player in the stablecoin market. They generate substantial revenue from USDC transactions and are investing heavily in building new products and services based on stablecoins. They're thinking long term.
So even if Bitcoin goes through a rough patch, which, let's be honest, it has in the past, Coinbase could still be in a strong position thanks to these other initiatives. That's fascinating. But the technology behind it all, the whole blockchain thing, it's still a bit of a mystery to me. What's the real world potential beyond just making transactions faster and cheaper?
Blockchain has the potential to revolutionize how we think about finance and move money around the world. Think about it, our current financial systems are slow, expensive, and often lack transparency. Blockchain technology could change all of that. Imagine a world where financial transactions are faster, cheaper, and completely transparent.
Wow, it sounds like something out of a sci-fi movie, but is that really achievable?
That's the big question, and it's what makes Coinbase such a compelling company to watch. They're not just facilitating transactions, they're trying to build the foundation for a whole new financial ecosystem. It's ambitious, but also incredibly exciting.
It definitely raises a lot of questions. For example, what about the regulatory landscape? Won't governments try to clamp down on all this and control it?
Absolutely. The regulatory landscape for crypto is constantly changing, and it's one of the biggest challenges facing Coinbase and the entire industry.
So there's a chance they could build this incredible technology but then get shut down by regulations. That's a scary thought.
It's a valid concern. But Coinbase is actively working with regulators to shape the future of crypto and push for clear, sensible guidelines. They're also investing a lot in compliance and security to assure they're operating in a responsible and sustainable way.
So it's not just a free-for-all with everyone making up the rules as they go along.
Exactly. Coinbase is trying to build a legitimate, trusted business in a relatively new and often misunderstood industry. And that's what makes their story so fascinating to follow.
It's definitely a high-stakes game. Coinbase could be leading a massive technological shift, or they could end up as a cautionary tale. It's hard to say what the future holds, but regardless, it's a fascinating case study, and I'm glad we took the time to delve into it.
Me too. It's a reminder that the world of investing is constantly evolving, and there's always something new to learn and explore.
And that brings us to the end of part 2 of our deep dive. We've covered a lot of ground today, from the ins and outs of real estate investing to the complexities of the crypto world.
But we're not done yet. In part 3, we'll wrap things up with some final thoughts and key takeaways to help you navigate these uncertain markets and make informed investment decisions.
Okay, so we've journeyed through the economic landscape, explored hidden gems and tech giants, even dipped our toes into the world of crypto and real estate. What a wild ride.
Been quite the deep dive, but remember, the goal isn't just to overload you with information. It's about empowering you to make smarter investment decisions.
Right. So as we wrap things up, what are the key takeaways? What should our listeners keep in mind as they navigate these complex and ever-changing markets?
Well, if I had to distill it down to one essential principle, it would be this: embrace the idea of being a contrarian investor. Don't just follow the herd. Think for yourself.
Contrarian investing, it's definitely a theme that's emerged throughout our conversation. But it can be a bit scary, right? Going against the grain.
It can be. But remember, the market often swings between fear and greed. And when everyone's panicking, that's often the best time to buy. And when everyone's overly optimistic, well, that's when you might want to consider taking some profits off the table.
So stay calm, do your research, and don't get caught up in the hype. Easier said than done sometimes, but I'm starting to see the wisdom in that approach.
And here's another thing. Don't be afraid of volatility.
Volatility. But isn't that what we're all trying to avoid?
It's natural to fear volatility, but think of it this way. Market swings create opportunities. It's during those dips that you can often find the best deals.
So when the market takes a tumble, that's our chance to swoop in and grab some bargains.
Exactly. But remember, be selective. Look for companies with strong fundamentals, those boring but beautiful companies we talked about earlier. Don't just buy anything because it's cheap. Make sure it's a quality asset that's temporarily undervalued.
Right, because a bargain isn't a bargain if the company isn't fundamentally sound. So be contrarian, embrace volatility, focus on the fundamentals. Anything else we should add to our investors' toolkit?
One more crucial ingredient, patience. Real wealth is built over time, not overnight. It's a marathon, not a sprint.
So slow and steady wins the race.
Exactly. The market is full of people trying to get rich quick, jumping in and out of investments, chasing the latest trends. But the investors who are patient and disciplined, those are the ones who ultimately achieve their goals. Remember the tortoise and the hare.
The tortoise and the hare, that's a perfect analogy. I'm officially adopting the tortoise approach to investing.
Great. And remember, the journey is just as important as the destination. Investing shouldn't be a chore. It should be an exciting process of discovery.
You're right. It's about so much more than just picking stocks or buying bonds. It's about understanding how the world works, learning about different industries and companies, and making informed decisions that align with your goals and values.
Absolutely. And it's an ongoing journey. The market is constantly changing. There's always something new to learn and explore.
And that's why we do these deep dives, to help you stay informed, explore new ideas, and ultimately feel more confident about your investment decisions.
So keep those questions coming. Keep sending us those articles and reports, and we'll keep digging deep to uncover those hidden gems and help you navigate the complexities of the market.
Thanks for joining us on this incredible journey. We'll be back soon with another deep dive into the world of knowledge and discovery.
Until then, happy investing.